Ladies and gentlemen, welcome to this week's version of Nichols and Dimes, our weekly video series. What does the transition to retirement look like? Well, let's first get to the quote of the week. Retirement is the only time in your life when time no longer equals money. Retirement is the only time in your life when time no longer equals money. I don't know who wrote this quote, but I thought it was quite telling. It's a fair point. Well, when you're working, you're in growth mode. Your goal is to accumulate wealth. And then when you're retirement, or when you're nearing retirement, the main goal is to preserve wealth and to generate income. It's a different way of thinking, and of course there's this transition. Now we deal with clients who are accumulating wealth that are still working, and we also deal with plenty of clients that are in retirement or distribution. And one of the main concerns that most folks who are transitioning to retirement have, or one of the main questions they have, is how is my portfolio supposed to look? And how does it adjust or change when I'm transitioning from my working years to my retirement years? Well, obviously, or maybe not so obviously, one of the main goals and focuses should be to focus more on preservation of wealth. Now, of course, when you're working, you want to likely take more risk. You have a longer time horizon to deal with the ups and downs of the markets. When you're nearing retirement or in retirement, the transition should likely be to more of a preservation mode, right? So you want to make sure you're lowering your risk of your portfolio. You're also wanting to make sure you have an asset allocation plan and a protection plan to mitigate or lower the risk when the markets have big downturns, because again, preservation now is the number one goal. And then the second goal beyond preservation when you're in retirement is now we have to start generating income. Now, of course, in your working years, most, if not all of your income was from your employment. Well, obviously, when you retire, there's no employment income. What the income that will turn on is potentially a pension, or very likely Social Security. And of course, those two things will be supplemented by your portfolio. So that means that your portfolio needs to generate growth and income to spin off enough excess cash flow to supplement your retirement. So again, the transition for most people is from a growth-oriented investment to now preservation and income. So the combination of those two things and how you invest and diversify your portfolio is very critical. Now, what we've seen over the last number of years, when the market takes a big downturn, we see the Federal Reserve printing more money, and obviously the stock market, likes it, and the market continues higher. I don't know how long that's going to continue. Certainly, the Federal Reserve has its foot on the gas pedal, and there's at least at this point no signs of that stopping. But all that to say is you cannot count on the Fed, in my opinion, to save you to protect your portfolio. You have to be proactive to create proactive asset allocation, diversification, and a game plan, if you will, to again hedge your portfolio. And then the second thing is, of course, to generate a consistent or reasonable income to supplement your pension and Social Security. To that end, if you would like a second opinion, if you are transitioning to retirement to see if you are in the right investments to transfer from a growth or accumulation portfolio to now when you're in retirement to a preservation and income portfolio, you could send us an email, cnichols@nicholswealth.com, or go on our website at nicholswealth.com to learn more. And by the way, I should note there's on our website at nicholswealth.com, there's a retirement ready quiz. You can click on that, go through the questions to determine if you are ready for retirement. Hope this helps and have a great day. Thanks for watching. Bye-bye.